Hello, hello. I'm getting ready to watch some football, and I wanted to share a quick thing with you. I've been asked, how do I safeguard my investments when I buy stocks? Because people who have significant wealth are really worried about losing money. And I have actually developed a very simple formula for helping you avoid stocks that have a ton of risk and to have a higher probability of growing in a portfolio. Of course, you want to diversify. So it's really a simple formula. So if you listen up here, it's 3C plus 3P plus SA. And I'm going to first start off with the 3Cs. The three C's are: number one, who are their customers? Are their customers stable? Are they growing? Number two is their competitive advantage. Do they have a product or service that is actually better than the competition or something that's a game changer? So that's the competitive advantage. Number three is costs. What is the cost structures that they have? Are their costs likely to increase, decrease? Are there very radically changing cost structures? That has to do with how profitable they can be. So you start off with the 3 C's. Who are their customers? Do they have a competitive advantage with their products? And what kind of cost structure do they have? Now, now we're talking about the 3 P's. The 3 P's are their people. Who are their management team? Do they have a track record of doing a good job? Do they have a track record of making smart decisions with capital? So number 1 P is people. Number second P is their position. What is their financial position? Do they have a lot of cash on the balance sheet or do they have a little cash? Obviously we want more cash on the balance sheet. Do they have a lot of debt or low debt? What is their cash position and their debt position? So, and the last P is performance. Is the stock being recognized in the marketplace for doing well? You should see the stock outperforming the market. And I have a simple acronym called TORC. Sometime I can go over that in terms of how it should perform. It has to do with its trend, whether or not it's extended, um, what its relative performance is, and whether or not there's quality psychology behind the stock. So you got your 3 C's: customers, competitive advantage, costs, plus your 3 P's, right? Who are the people? What kind of financial position are they in? And how is the stock performing? Now, the last part is how you deal with trading and investing. Okay, the first two parts, the 3 C's and the 3 P's, that has to do with the what. What am I looking for? The last part has to do with how do I invest in it. The first is safeguard first. So the last part is SA. So S stands for safeguard. Safeguard basically means you have to determine how much you're going to risk, and then you size the position accordingly, and you do not hold on to a position that is not working, no matter how great your fundamental analysis is. Maybe the market's not right. Maybe the government is doing something wrong. So safeguard. The second is an A, which stands for asymmetric. That's just a fancy word for you want to have you want to let your profits run and you want to cut your losses short. So you want to have an asymmetric payoff where the upside is very big relative to how much you're risking. So that's it. It's really simple. And I'll write it in the actual notes here. It is 3C plus 3P plus SA: customers, competition, costs, people, position, performance, safeguard, and asymmetric. All right, that's it for now. I'm getting ready to go watch some football. You guys have a great day. Bye.